Hey everyone, welcome to the KE Report and a daily editorial on Thursday, September 18th, chatting with Jeff Christian. Jeff is the managing partner at the CPM Group. We bring Jeff on a monthly basis for an update on the metals sector, a lot of the time talking simply precious metals because, well, those really have been the headline moves in the precious metals prices, especially as we moved into September. First few trading days in September as everyone got back. Fact of the matter is, gold, silver, they both broke out. Gold was in about a 5 month long consolidation where it was struggling to break out, but it also wasn't breaking down. That was in the face of a lot of people, technicians especially, calling for some sort of pullback. It seemed like that consolidation or that pullback happened more in time rather than in price. So, Jeff, let's start with gold as it made another leg higher, up over $3,700. Now we have the Fed rate cuts. Gold showing a little bit of weakness on the back of that. But what's your outlook for gold?
Yeah, we would not be surprised to see the price come off further. We've been seeing $80 swings in the gold price. And quite frankly, because the price has spiked higher, really since the middle to late August, really since the Kansas City Fed's Jackson Hole, Wyoming meeting, you've seen the gold price go from 3,350 to, as you said, 3,755 or whatever. The peak was yesterday. Yeah, the peak was $3,744 for the December contract, which is what we look at. We wouldn't be surprised to see the price come off in the next couple of weeks or so. But looking at the fourth quarter, we have put in our precious metals advisory report that we would not be surprised at all. In fact, we put it in as a projection that the price of gold could get to 3,800 over the course of October and November, and probably get to 4,000 by December, if not December, January. So we're looking at, a world that is still very chaotic and very risky, and we expect investors to continue to buy gold, pushing the price up.
Well, Jeff, in lieu of the more bullish outlook, there's still a lot of technicians and a lot of pundits that are expecting to see a pullback. And we were talking off mic before this call that even if there was a typical correction, let's say 10 to 20%, it wouldn't be without the realm of reason to still see, solid support come in and buying there just because of all the macro factors. But what do you think about a pullback scenario? What would it look like in your opinion?
Yeah, we talk about a 20% pullback because if you look at 2022, the price of gold got to $2,080 in the first quarter of 2022. Russia had invaded Iraq, Ukraine. There were all kinds of other issues going on in 2022. And the price fell from 2080 in the first quarter to a low of $1,680 in the first week of November of 2022. That decline reflected profit taking by investors. And there was a lot of gold that was sold by investors, including institutional investors. There were 10 million ounces of gold sold during that period of time in China alone that did not find ready buyers. So it was backed up in the market. You had this 10 million ounce stash of unwanted gold during that period of time. But when the price got down to 1680, everyone started buying. The People's Bank of China had stopped buying when the price got over 1300 in the middle of 2019. And they hadn't bought any gold from the middle of 2019 until November of 2022. And when the price fell, 20% to 1680, they said, okay, our threshold had been 1350, and 1680 is $300 more than that, but it's off 20% in 9 months. This is probably a good time to buy. So we talk about 20%, but we have no expectation that you'd see 20%. Even if you did see a 20% sell-off right now, that would take the price down to around $3,000, which, prior to April of this year was unprecedented. It was a record price when the gold price broke above $3,000 an ounce. Actually, in February, I guess it was testing that in February. It broke forcefully above it. in March and April. We're not looking at a 20% decline. We're looking at a lot of people who want to buy gold on the dips. And so, if the price went to 3,600, we think you'd see a lot of demand come in. There's all kinds of support levels. And as you said, the technicians are at a loss here because you're in unprecedented territories. You don't have historical price action to pay a lot of attention to. You do have things like measured moves and pennants and triangles and all that other stuff that these guys look at, and momentum indicators. And one of the things that we are seeing is a tremendous amount of short-term buying and selling based on price momentum indicators. But that's nothing new. So yeah, but you have all sorts of support between where we are right now, $3,660, I think is where we are right now. You have all kinds of support between there and say 3,500, or even going down to 3,300. We don't think you'll see 3,300 because we think that there's so many investors who will come in and buy on these dips that the downside, while it exists, is far less than the upside potential.
Jeff, the big question, I think, is look, we all know we're in a bull market here, and pullbacks are natural in bull markets, but how will we know, or what are the signs of a market top, something more than simply a pullback in a bull market?
Well, yeah, we look at the technicals because technicals there are a lot of people who trade basis of technicals, but we ultimately base our expectations and our projections on the fundamentals of the market: supply, demand, fabrication demand, investment demand, and other variables that are fundamentals to the gold market. And when you look at that, you see that the gold price is largely the most important factor determining gold prices. What levels are they rising? Are they falling? Is investment demand. And investment demand, in turn, is almost exclusively determined by economic and political and social and financial market risks and expectations and perceptions of risk. So when and yes, people have been asking us continually, what's the sign for a peak? The sign for a peak will be, prices will stop rising when investors stop buying, and investors will stop buying when they can look at the world or their country or their bank and say, okay, I can exhale. So the indicator that we'll watch for that says this is a peak is an improvement in the political and economic environment. And we run all sorts of scenarios about that. And most of the more probable scenarios right now are negative for the next year or two. We thought the price could get to 4,000. We've been predicting that, I think, for years. And we thought that it would get here around now. What we're finding is that a lot of our high net worth individuals and institutional investors that take our advice say, okay, you were pretty good. You picked the period 2024 to 2026. You picked the economic environment, the political environment, and you picked the prices. So now the price is $3,700. We've made a tremendous amount of money. This is where you said we might be wanting to take profits. We don't want to sell our gold because we look at the world in a forward-looking way, and we say all of these problems that have caused everyone, including ourselves, to buy gold have not gone away, have not gotten better, they've gotten worse. So we're doing a lot of advisory work right now on hedging your long position for investors, not for producers, but for investors, because they want to stay long gold and silver, but they would like some downside protection given the fact that, calmer heads in 2019, 2018 said, hey, things could get really nasty over the next 6 years, 10 years, and the price of gold could spike up to, unprecedented levels of $3,000 or $4,000 an ounce. And so you're there. Do you change your view? And, as John Maynard Keynes said, when the circumstances change, I change my opinion. What do you do?
Well, it's a good point, Jeff, and it sounds like we may still be waiting a little bit longer to exhale before we see cooler heads prevail. So still the risk to the upside as far as some of the negative effects and how that propels gold higher. But we have gotten back into this Fed rate cutting cycle, and there's all kinds of narratives around interest rates and how that drives the price of gold, at least in US dollars. The narrative was, though, that in a hiking environment that would be bad for gold, yet gold kept going higher. The prevailing narrative is that in a cutting environment, it's good for gold because as rates come down, the carrying cost of gold looks less onerous. What are your thoughts as far as interest rates and how that relates to the price of gold?
Yeah, the whole idea that, higher interest rates are bad for gold and lower interest rates are good for gold, that's total nonsense. The correlation in month-to-month changes between interest rates and gold prices is like 16%. And, in our gold yearbook, we have this scatter plot drawing, and we show you that there are times, a lot of times, well, okay, if it's 16% of the time gold and silver are moving in opposite directions, that means that 84% of the time they're not. There are times when they're both rising, there are times when they're both falling, there are times when they're just not correlated at all. And the answer is you have to say, why are interest rates rising or falling? That's what really matters. Well, interest rate levels matter to some extent. Lower interest rates make it cheaper to own gold. Your opportunity cost of not owning gold is reduced if you're not going to be earning as much in interest rates. Although I have to say, even with the quarter point cut this week and another quarter point or so over the next period of time, interest rates at 3.5%, they're 4% now. Let's say they fell all the way to 3.5%. That's very good by post-2011 standards. From pre-2011 standards, we are below typical interest rates already. We have low interest rates at 4%. But going forward, lower interest rates may reflect, as they did yesterday, concerns of overemployment, concerns over recession, concerns over inflation. And those concerns cause people to buy gold as, too. So when people say, well, lower interest rates should mean higher gold prices or higher interest rates should mean lower gold prices, we go into this whole big, economics 101. If you look at the statistics, your theory might be very interesting. It might sound really valid, but if you look at what happens in the bond market, the interest rate market, and gold market, your theory doesn't hold up to empirical evidence. And I happen to prefer living in a data-driven world as opposed to a theoretical world.
Jeff, any data around U.S. markets relationship to gold? Because right now they're both continuing to move higher. And, well, you can make the argument that if the markets are moving higher, then why would people be going into the safety of gold? But the other argument being kind of inflationary market environment where everything's moving up together, so people are spreading their profits out.
Exactly. The long-term correlation between the Dow Jones or the S&P and gold price changes in the stock market indices and changes in gold prices. The long-term average since 1970, when the gold prices were basically free, is negative 3%. Right. So there's really no good correlation. If you just look at the period from like 2008, the Great Recession, until now, the correlation's negative 6%. So there is no long-term thing. And that's one of the advantages of gold is it doesn't correlate negatively or positively with stocks or with bonds. So it's a beautiful portfolio diversifier because there'll be times when they're both rising, there'll be times when they're both falling. And the second point you made is the one that's really the most important thing, especially in a situation like now where you are in the late stages of an economic expansion and you've seen an extended period of rising stock market indices that are based on just a handful, like 10% or fewer of the stocks in those indices are actually doing well, and the other ones are sucking air. So you've got a stock market that is very highly valued, it's in the late stages of a bull market, in the late stages of an economic expansion, you're very vulnerable. So if you're an intelligent investor, you're saying, I've made a lot of money in stocks. It's time to get some of that money out and put it into other assets like gold. We had a situation probably about 10 years ago in China where the stock market was wildly overvalued, but the gold price had gone from $1,900 peak down to like $1,200. And we were talking to our institutional investors in China saying, ought not you take some of your money out of the stock market and put it in gold? And universally, they said, no, that's not how Chinese investors work. We're all in. So all of us believe we can be the first one out the door when someone yells fire. So we will be in the stock market until it's plunging. And then we'll get into gold. And that's not a Chinese trait, that's an investor trait. So yeah, you've got a situation right now where there are a lot of people looking at the stock market, boy, I'm really well off. And they're not doing anything about it. But we did have a period of time a year or so ago where the stock market came off, and there was all this hand wringing, and you saw the gold marketeers online talking about how the stock market was going to fall 20 or 40 or 80%, and it didn't happen. Stocks turned around and moved to new highs. So a lot of investors saying, like, I'm just not going to believe that the stock market could crash until it crashes. But there are some who are getting out and putting some of that money into gold and silver.
Well, Jeff, we can't wrap up with you until we get over to silver. So let's get your outlook on the silver price. It's done quite well, broke above 40 and now above 42, tagged 43 recently on the futures. What's your outlook on silver?
Our outlook on silver is pretty much the same. Again, we wouldn't be surprised to see some profit taking. We think that there's a lot of demand out there right now, which probably is going to support the price above $40 in the near term. I think that we're talking about higher prices over the fourth quarter. I think we were talking about $44 to $48 in the fourth quarter of this year, and probably touching $50 next year. We don't necessarily see it going much higher, but there are two physical fundamental points I would make. If you look at the silver price, 1978 to 1979, well, really 1975 until 1979, you saw investors selling silver. And as 78 and 79 progressed, especially 79, you saw investors pulling back from selling silver into the market. So you had disenchanted investors who had bought silver in the run-up 1973 to 75. They were getting rid of it through 78 into 79. But then they said, maybe if I stop selling today, I can get a higher price tomorrow. So they waited a day and the price rose. And they said, well, maybe I'll wait another day and it started rising. So the first indicator in the silver market was a reduction in investor sales. That happened in 1979, 1980. It happened again 2002 to 2011. And it's been happening now again. So we've seen very heavy disenchanted investor selling over the last 2.5 years. And it's starting to dissipate now. That's the leading indicator of future net purchases by investors or gross purchases by investors. First I stopped selling so much, then I stopped selling completely, and then I start buying again. And other new investors come in and say, oh, wow, the silver price is rising. I got to get some of that upward momentum. So that's where we are right now. We're sort of like late 1979 or 2011 in the silver market right now. We're seeing those investors that have been selling, keeping the silver price down relative to gold. They're kind of backing away from selling. And you've seen newer investors, especially a lot of short-term, technically driven generalist investors coming into the silver market. So that supports the idea of higher silver prices over the next period of time.
Real quick then, Jeff, what are some of your targets for silver, I guess, but even gold into next year? What could we be in for?
Well, like I said, we have an initial target of $4,000 for gold. over the course of next year, and initial target of $50 an ounce for silver, not necessarily on an annual average basis, but at some point over next year. But we're wrestling. We do 10-year projections of gold, silver supply, demand, and price going out 10 years. We update those on a quarterly basis usually, and we missed the second quarter because we've been sitting here studying the market, and the amount of uncertainty and the number of risks are so great right now that we've expanded the number of scenarios that we talk about in public. We've always run these different scenarios, and our view is that gold and silver price is going to rise in 2026 and possibly into 2027. And one of the big questions our clients keep asking us is like, well, you say that the prices will peak at some point and come down, and you say that the prices are rising because investors are buying because of economic and political problems. What economic and political scenario or solutions do you see in 2027 or 2028 that would cause that train to take a pause, at least on a cyclical basis, and decline? And the answer is we don't see things improving, but we see societies, financial markets, and investors normalizing the higher levels of risk and uncertainty that have become and are becoming more common in financial markets.
All right, Jeff, we'll wrap it up here. As always, interesting to hear your take on the precious metals. And look, it continues to be a very good environment for precious metals as breakout, again, coming after a fairly lengthy consolidation. And during that consolidation, the stocks played some catch up to the metals prices. And now having gold break out and potentially move to $4,000 sooner rather than later, I'm sure just keeps that bullish narrative on a lot of people's minds and radar. Again, Jeff Christian, managing partner at the CPM Group. Click the link in the show notes to learn a little bit more about the CPM Group. Jeff, as always, thank you for your time, and we'll chat again next month.
Talk to you then.